Hello, I'm Michelle Davis, an Associate Financial Planner with Trillium Square Advisors. I want to talk with you today about tax-deferred growth. What is it, and what can it do for you? Let's start with, what is tax-deferred growth? Basically, this is where money grows or income is earned, and you legally don't have to pay taxes on it until later. Some of the most familiar ways to do this are with a retirement account like an IRA, or a college savings account like a 529 plan. There are actually multiple other options like 401ks, covered education savings accounts. However, since the tax-deferred growth essentially works the same, I'm just going to stick to IRAs and 529s or 529 plans. Contributions to a traditional IRA or an individual retirement account are typically tax deductible, which means that they reduce your taxable income for the year in which the contributions are made. The money in the account grows tax-free until it is withdrawn in retirement, at which point the amount taken out is taxed as ordinary income. This tax deferral can have a significant impact on the growth of the investment over time, because the earnings are not subject to taxes during the accumulation period, which means more money stays in the account. That money also compounds or grows upon itself, which significantly increases growth potential. Here's an example. Suppose you contribute $5,000 to a traditional IRA each year for 30 years, say starting at age 35 and stopping at age 65. And your average annual return is 7%. If you are in the 24% tax bracket, your tax savings each year would be $1,200. By the end of 30 years, your total contributions would be $150,000. But your account balance would be over $470,000, assuming no withdrawals, because no taxes were paid on the earnings, and the earnings compounded upon themselves during the accumulation phase. Next up, let's look at 529 plans, which are college saving plans that offer tax-free growth and withdrawals when used for qualified education expenses. The contributions to 529 plans are different from traditional IRAs because 529 plan contributions are made with after-tax dollars, which means you don't get a tax deduction for the contributions. However, the earnings on the investments do grow tax-free, and withdrawals are tax-free as long as they are used for qualified expenses. The tax-free growth can have a dramatic impact on the growth of the investment over time, especially if you start saving early and have a long time horizon before your child starts college. For instance, suppose you contribute $5,000 to a 529 plan each year for 18 years, and your average annual return is, again, 7%. By the time your child starts college, assuming no withdrawals, the account balance would be nearly $170,000 when you contributed $90,000. Again, because no taxes were paid on the earnings, and the earnings compounded upon themselves during the accumulation phase. Assuming you're in the 24% tax bracket, the tax savings from the tax-free growth on the account would be approximately $19,000. In both cases, the tax deferral feature of these accounts can have a significant impact on the growth of the investment over time. I hope this information helps you with your financial planning. If you're not sure what's best for you, it's important to work with a holistic financial planner who takes a look at your entire situation to determine which type of account is best for your individual circumstances and investment goals. Our goal at Trillium Square Advisors is to serve you by making your money work harder for you so you can pursue your dreams.